What's up everybody? I'm Leaf with Adaptable Wealth, and in today's video I'm going to reveal some of the hidden risks that you may not know you're taking when you invest in an index fund. If you've ever stepped your virtual foot into FinTwit, you'll be bombarded with the slogan, index it and forget it. The vast majority of participants think that everyone should take the market return and go on with their lives. And to some extent, I agree. Buy a low-cost index fund and let time and compounding do all the work. Study after study shows that passive funds outperform their active counterparts over long periods of time. But return is only one part of the equation when it comes to investing. Risk management is the other, and I think you'll be surprised at some of the risks you're taking without knowing it. In the interest of fairness, let's first cover some of the benefits of index investing. First, they're simple. There isn't much more to do other than buy the index fund that tracks the index that you want to invest in. Second, they offer low expense ratios. The average active fund charges approximately 8 times the fees that passive funds do. And according to Morningstar research, fees are one of the best predictors of future fund performance. Third, index funds offer superior long-term risk-adjusted returns versus their active counterparts. It's not uncommon for active funds to outperform passive in a given 1 to 3 year period, but once you get into the 5-year range, active management falls behind in nearly all categories, and it only gets worse as you move out into the 10, 15, and 20-year time frames. Lastly, they generally trigger fewer taxable events. Since investments within an index do not change frequently, the investments that track the index do not change frequently either. This generally means less taxable events within index funds versus active ones. If these are the qualities of an investment that you're looking for, then there's nothing wrong with investing in index funds. However, a prudent investor seeks to understand the full picture of an investment because what you don't know can hurt you. The first hidden risk is that fees are not the same as costs. Earlier in this video, we pointed out that lower fees associated with index funds as one of the benefits, but fees are only part of the total costs. The cost of passive investing is much higher than the expense ratio that you pay in an index fund. There are 2 downstream effects that increase the true costs for all market participants whether or not they invest in index funds. They are the impairment of price discovery and the concentration in the asset management market. In a free market economy, prices are the most important variable there is. It's the primary mechanism by which resources, in this case money looking for an investment, are allocated. Index investing outright ignores it. For example, say you put $1,000 in the Vanguard 500 ETF, ticker VOO. Vanguard is required to allocate that $1,000 based on the weighting of the companies within the S&P 500 at that moment. As the purchaser of VOO, you're investing $2.60 of your $1,000 in a company called Chubb International. Not sure what the Chubb International does? Yeah, me either. Well, whether you like it or not, you're buying some Chubb International. And regardless of whether it's trading at 10 times earnings or 1,000 times earnings, you're buying. You're a price taker. There is no price discovery in this process. It's like you buy 504 pairs of shoes, regardless of their price, just so you can own the ones that you really want. Question for you. What do you think happens to the price of Chubb International when millions of people buy their stock just because they invested in VOO? Yeah, it's higher than it otherwise would be. Now, I know you're probably screaming at your screen right now, saying, come on, Leaf, $2.60 for every $1,000 I invest? That's not a big deal, and I understand where you're coming from until you realize that there are hundreds of other companies in the S&P 500 that you've never heard of, you know nothing about, yet you're buying their stock. The next and much more problematic cost of passive investing is the concentration in the asset management market. The concentration of fund-based assets under management over the past couple decades has been staggering. Blackrock, Vanguard, and State Street receive approximately 80% of capital allocated to investment funds today. More troubling is the fact that they are the biggest shareholder in 88% of S&P 500 companies and 40% of all listed U.S. companies. Ask yourself, do you think these asset managers vote for initiatives that increase competition, which would likely lower the profits of the companies that they hold? This article from the Harvard Business Review outlines why they have the incentive to use the corporate governance framework, aka voting shares of stock, to reduce competition, keep output from expanding too much, and ensure that prices of goods and services don't fall. Horizontal shareholding therefore hurts competition because, as Einar L. Hwag of Harvard Law School has argued, it reduces each individual firm's incentives to cut prices or expand output by increasing the cost to shareholders and thus managers of taking away sales from rivals. In another investigation, Cambridge University found that voting strategies of the Big Three show signs of coordination. In summary, investors may benefit from lower expense ratios, but they pay for it in terms of higher prices of real goods and services, in addition to higher prices of stocks due to the destruction of price discovery. Please like this video and subscribe to this channel. This is the easiest way that you can help me grow this channel if you find this content valuable. The next hidden risk with index funds is the fact that the extent of diversification that they offer is a mirage. Proponents of index funds argue that you can get instant diversification by just investing in one fund such as VOO. With an S&P 500 index funds, you hold 504 different companies, so you must be well diversified, right? To some extent, sure, but not to the degree that those offering you the investment would like you to believe. The first reason for this is the company concentration within the indices. Not only is there concentration at the asset manager level, but there is also concentration within the indices themselves at the company level. Currently, the top 10 companies in the S&P 500, which make up 2% of the 504 companies, account for 27% of the weighting. The top 5 companies, or 1%, account for 19% of the weighting. The second reason an index fund doesn't offer the extent of diversification that you've been led to believe is the fact that there has been increasing correlation between the movements of stocks within the indices. The main purpose of diversification is to reduce volatility and stabilize returns. In order for this to be true, there must be a meaningful lack of correlation between the assets themselves. For example, let's say you hold one stock. If it goes down by 10%, then your portfolio also goes down by 10%. Now let's say that you add a dozen stocks to your portfolio, all of which have high correlations to each other and the market. If the market goes down by 10%, all of those stocks are going to go down by about that same 10%, and so will your portfolio. You have done nothing to protect against the drop in the market. Just adding companies does not mean you're more diversified. You must hold assets that generally behave differently than each other, especially during market downturns. The problem is that companies within the S&P 500 index exhibit significant co-movement. Co-movement is the term for the number of stocks that rise or fall on a given day, and as you can see in this chart, it closely approximates correlation. From 1940 to 1996, co-movement stayed in a tight range. Starting around 1996, though, the co-movement, aka implied correlation, of stocks in the S&P 500 has shot up significantly. Even worse, co-movement spikes during times of market distress. As you can see in this chart, it spiked during the dot-com crash, it spiked again during the Great Financial Crisis, and it went to the moon during the COVID crash. In other words, the exact times that you need diversification to do what it's supposed to do, the companies in the S&P 500 index do the exact opposite. The final major hidden risk of passive investing is that there's a chance that you're not buying what you think you're buying. When ordinary people invest their hard-earned money in an S&P 500 index fund, they, along with almost all investment professionals, think, hey, I'm buying the 500 largest companies trading in the US stock market. They're in this group because they're good companies, so there isn't much risk. If you're one of those people, you'll be surprised to know that the credit ratings of the S&P 500 companies are lower than you'd think. As of the end of 2021, there were 138 of the 504 companies, or 26%, rated as medium investment grade or better by S&P. This means a staggering 74% of S&P 500 companies were rated low investment grade all the way down to junk. I include investment grade here because it's the last bucket in the investment grade, and one downgrade could result in owning a company in junk status. In fact, downgrades are not uncommon. According to Investor Business Daily, many well-known S&P 500 firms such as Las Vegas Sands, Marriott, Coors, and Kohl's were on the brink of junk status as of April 2020. My question to you is it smart to own companies that are barely investment grade or even junk status as long as you own 138 other companies? Then there's the manipulation of PE ratios. I learned about this one from a video on Real Vision a couple years ago. In a nutshell, funds can use several strategies to show a much lower PE ratio than what the underlying investments offer. To name a few, they can use a weighted harmonic average. They exclude unprofitable companies because you can't get a meaningful PE ratio with negative earnings. And you can throw out companies with extremely high PE ratios because they're considered outliers. If you'd like to learn about this in more detail, I highly recommend that you watch the video. You'll find a link in the description below. The third case of index investors not knowing what they're buying is the fact that some ETFs are considered synthetic ETFs, which means that they do not invest directly in the underlying securities that they claim to represent. Instead, they use derivatives to invest indirectly in the underlying companies. And unless you are aware that these type of funds exist, you may end up holding a bag of derivatives disguised as a normal ETF. Of course, any fund that partakes in such activities must legally notify investors in their prospectuses and other marketing materials. So make sure that you read their marketing materials carefully and do your due diligence. Add to that the fact that many index funds lend their securities to generate fee revenue, and you'd wonder how they'd be considered passive investments in the first place. It doesn't take a genius to realize that this introduces counterparty risk to the ETF, which an investor may not be aware of. Now, the ETF typically requires collateral, but some do not. And the collateral can be anything from treasuries to asset-backed securities, think subprime mortgages back in the day, all the way down to derivatives. According to Morningstar, the collateralization usually ranges from about 102% to 105%. And at first, this over-collateralization sounds good until you realize that at 105% collateralization, a measly 4.7% drop in the value of the collateral results in a loss to the ETF and therefore investors. Morningstar also states, and I quote, that the strategy risk always overshadows securities lending's returns, and high securities lending returns are eye-catching, but no amount of lending revenue will offset risk inherent to the underlying strategy. Then there is the possibility that the borrowing company goes bankrupt. Final example of index investors investing in something that they may not be aware of is the fact that as an index investor, you're participating in momentum investing. With a market cap weighted index like the S&P 500, each company's market cap determines the proportion of your money that goes into each company. And there are two variables that go into the calculation of market cap. First is the price of each share, and then second is the number of shares outstanding. Holding all else equal, if the number of shares outstanding increases, then so will the market cap. In other words, you're buying more and more and more of a company as your stake is being diluted by the company. And it's one way companies steal from investors in order to help finance the company. As I mentioned, the other variable is price. Holding all else equal, the weighting of a company increases just because the price increases. This means you're buying more and more and more of a company as the price increases, which is called momentum investing. And it's not the same as the prudent investment strategy that the average investor thinks they're participating in when they buy an S&P 500 index fund. If you're not aware what momentum investing is, it is a buy high, sell higher strategy that can easily blow up in your face. There isn't anything wrong with momentum investing per se. Tons of people use it, primarily traders. It's just not what the average investor thinks they're doing when they buy an S&P 500 index fund. As I mentioned in the beginning, this video is not intended to dissuade you from investing in index funds, particularly S&P 500 index funds. In fact, I hold a significant amount of my financial wealth in such funds. But if you want to be a prudent investor that adheres to the timeless principles of investing, then it's important that you understand the risks that you're taking with your money because it can easily be lost. One of those timeless principles is risk management. One of the things that pisses me off the most about investment advice on FinTwit and other social media platforms is the idea that if you're not 100% invested in stocks or real estate, if you ever sell and hold some cash and you don't mindlessly just buy, regardless of what the price or market is doing, it's called dollar cost averaging, by the way, then you are trying to time the market. It appears that prudent risk management has flown right out the window over the past 20 years. Well, I'm here to tell you that it hasn't. The same timeless principles of investing and spreading your money around in various asset classes still applies. You should own some stocks, you should own some bonds, you should own real estate and Bitcoin and gold and silver. And once you establish a good foundation, you should consider alternative assets such as farmland, cars, art, watches, etc. This is how real diversification is practiced. You need to spread your money across several different asset classes. Holding different types of stocks offers little to no protection on the downside because they all tend to move together anyway, especially during crashes. Until next time, you all take care and remember that wealth is not only about money and things. Your time and health are just as important, and working to improve all three pillars of wealth is key to being adaptable, resilient, and thriving in life.